Good morning, everyone. This is Bridget Polachine with the IIB, and I want to thank you all for joining us for the third in our series of COVID-19 webinars presented in partnership with our valued association professional members. Today's session, we're very pleased to have our partners from Oliver Wyman lead us in a discussion about the impact of COVID-19 on credit markets, one of the most pressing and critical issues our members face. They'll be talking to us about how banks should respond to the challenges presented by COVID-19, the specific risks, how to analyze them, and suggestions for how to respond, including by revising loss forecasting models. Guiding us through the discussion today are Adam Schneider, Ross Eaton, Scott Bradal, and Francois Franzel, each part of the Oliver Wyman Risk and Public Policy team. We're very fortunate to have the expertise of the OW team available to us today and really any day. And we encourage you to take advantage of this unique opportunity by asking questions throughout. You can submit questions through the Q&A function on Zoom or email them to us at info@iib.org. As per our usual practice, following today's webinar, we will email all of you the slides and a link to the recorded session, which will be available on our YouTube channel, in the members only section of the website, and Zoom on demand. So thank you all for joining us today. Adam, I'll virtually hand the mic over to you.
Well, thank you very much, Bridget, and let me thank the IIB as a whole and the members for joining. This is kind of a critically important topic in the unusual times we find ourselves. We hope you find it all interesting. For housekeeping, we're scheduled for 1 hour. Bridget's already gone through some of the instructions on asking questions. We welcome your questions. We'd love to talk with you more interactively. And thank you all very much for the opportunity and for the benefit of the time. We have a very experienced set of people to talk through the set of issues and conversations on credit. We've been playing with credit for any number of years, and this is perhaps the most interesting market we have all ever seen. We hope that we can add a lot of value to your own thoughts and processes. So let me introduce who is talking today. I guess I introduced myself, Adam Schneider, partner with the firm. I am driving our credit offering really specifically to COVID, both on the consumer and, of course, in this case, much more on the commercial and industrial side, because it really is a very different beast and is a very different type of problem. You'll hear from Scott Bradal. Scott is a partner also in the risk practice. He has north of 20 years experience in risk. He ran our risk practices previously overseas in Asia Pacific and also has been up in Canada extensively. And Scott really brands a broad base of experience in enterprise risk, credit risk topics, work on commercial and corporate credit models, and credit processes. And again, unique time, deep expertise. Ross Eaton. Ross is a partner. You may know this from the accent. He's also from overseas. He is really focused on loss forecasting, the effects of stress testing, the effects of CECL, the effect on integrated capital planning. He leads our work across the Americas in corporate and commercial credit risk quantification under COVID, which of course is really interesting because not a lot of credit models had a pandemic in them before. So it's a very interesting set of processes and expertise. Francois Franzel, you will hear the accent, work with major banks in a variety of financial and risk management issues across 15 countries, supported the major European regulators on their asset quality review a few years ago, basically reviewing and valuing commercial credit exposures across the EU. And he has been all over this issue in terms of the Euro crisis. And of course, there are analogies with what we're experiencing now, both with the financial crisis of 10, 12 years ago and the Euro crisis subsequent to that. Here's our agenda for today's session. Pretty straightforward. First, we're going to start with some basic facts on the shifting economic landscape. Then Scott will take us through responding to the challenge and what folks have been doing and implementing. Ross will take us into navigating the pandemic and how we think credit tools will inevitably need to evolve. And last, a very, hopefully well-meaning, and we want your input, closing remarks and Q&A. There'll be instructions at the end, but you can do Q&A at any time right on your screen, and they'll be kind of stacked up, ready and waiting for us to go through it. And if we have the privilege of getting more questions, that would be fantastic. We're here to go help your institutions. Bit of personal background. I am a veteran of the great financial crisis. I ran our firm's credit crisis task force back in that day, servicing clients. So there's a little bit of a rerun reality to COVID. At a personal level, I'm a bit of a bear on the current markets and the current economic situation. So just fact of life, I tend to think that way. But let's get into it and see what their role is. What's absolutely remarkable to us is the unprecedented impact across many, many spaces from COVID-19. You may all recall February was not that many months ago, like 3. And since then, if you look at the New York Times headline on the left-hand side, that deep red line is unemployment compared to the rest of the time that we've tracked unemployment. It literally fell off the bottom of the page. It's a remarkable graphic. And related to that is multiple reasons for defaults. But you can see some of the more interesting and important names on the right-hand side with a skewing to retail and travel and related, but not 100%. Because individual corporates had their own situation, individual institutions had their own credit problems, and someone who delevered in February versus levered in February really might have won or lost, depending on the circumstance. The bottom right chart is pretty straightforward. The speculative default rate is really, really, really pretty high, and we have a couple of forecasts over there, and the most pessimistic forecasts are up in the circa the 20% range. 20% default rate for speculative grade credit, which is absolutely astonishing given 3 months ago we had a economic expansion, we had record low unemployment, not record high unemployment, and we've had to think about this in unbelievable real time. And just to be fair, at a time when most of your institutions are driving to work from home, setting up new processes, setting up new capabilities, et cetera. We had one client that models broke to the point where they essentially predicted every entity that was being tracked would default on every loan because, in fact, gee, that's what the models indicated. If you kind of take the negative lines and extend them, they went to everything. So that's probably not going to happen. But we have major, major and important names. Over the weekend hurts, but from a wide variety of entities and not so easy to predict in advance. So clearly related is the credit market is very, very industry dependent, I think in very unique ways because of COVID than in the past. We were in a traditional commercial industrial recession. You would see manufacturing, for example, which is on the right-hand side, is in the green category, kind of be first in line as inventories built up and people cut back orders. That has not been the experience here. So the right-hand side is credit default swap premium and basis points. So it costs just under 6% to insure debt as of a couple of weeks ago in entertainment. And you can see that there's an extraordinary premium for certain industries that are either tied to physical presence like amusement parks, the oil industry in general due to the price collapse, air transport for obvious reasons, manufacturing for similar reasons, land transport, all kinds of crazy numbers relative to where they would have been 90 days ago. And we use the credit default swaps market, which may or may not be perfect in terms of your loan book, but at least it is market readable and indicative. and it is shockingly orange, if not red, depending on the circumstance. By the way, I would note that air transport has had specific government help. We'll talk about that in a moment, but one of the reasons is only 300 basis points versus 500 basis points is that actually there's targeted relief there as a vital industry. Similarly, and there's really something missing on the left-hand side that I'll talk through, the impact on bond yields is really unbelievably spiky. So the yellow line is triple B, the blue line is single B. And of course, they've spiked up, and the Federal Reserve has intervened somewhat dramatically. But let's remember something else. At the same time, the cost of money has spiked down, which we didn't show on the chart because it was kind of in the bottom, bottom decile or so of the chart space. In 2008 to 2010, the cost of money went up to about 400 basis points over LIBOR, from a 400 basis point gap from where it was. In 2020, the cost of money went down, where the LIBOR rate is approaching 1 basis point, for example. So not only did the market go up, but the actual cost cycle in terms of what is kind of normal went down. That gap is bigger than it appears to be on the chart, and it's an enormous thing. And our net summary is we're in orange to red status and no sign of things getting greener at this moment in time. I think we're all familiar with the various federal government programs, and we're not going to deal with the consumer programs, but of course the consumer programs help smooth out a lot of things that show up in the commercial markets. On the credit flow to large business, commercial paper, primary market, secondary market, in terms of credit flow to consumers and medium-sized business, TALF, Main Street lending, payment protection program, which has an element that keeps the businesses alive. Even the money market funds are part of the deal over here, as well as governments and hospitals. So here's the number, $5.7 trillion in the US market in already passed government support. It is an unbelievable total number. If you just take the corporate and business market, just the corporates and businesses that you would on average be lending to, it is 2.4 trillion of support, over $1 trillion in direct support, and on the order of 11% of gross domestic product. It is an extraordinary level of support for essentially a recession, or worse, perhaps a depression that has come from the outside, come via COVID. An extraordinary level of support when all is said and done. Now, it's one thing to say unemployment has gone up. It's another thing to say that industries can't pay back. Of course, we have this little thing called the virus. And it turns out that the virus, by causing us to choose to close our businesses and having people basically shelter at home and social distance, has caused an awful lot of the problem, more so than almost any other scenario. Unemployment went up, but an awful lot of it is people not working and staying home. We built a tool set called the Pandemic Navigator that really lets folks think about what are the geographical constructs. So, for example, let's say you're lending into heavy machinery and they have dealers. Well, if those dealers are scattered across, in this case, Southern California, they're not open yet. And if they're scattered across Wyoming, they probably are open yet. So for the first time ever, we've had to think about how does a pandemic or any disease affect our business outcomes by geography? A very bizarre set of problems that we are busy working through with our navigator. Similarly, I think we've all lived through the first outbreak. The question, unknown, I think at this point in time, is will there be more outbreaks? If you recall, and I'm a New Yorker, we got imprisoned in our relative homes because the outbreak couldn't exceed the capacity of the medical system, and clearly got pretty darn close. Well, there's a theory that we'll open it up again and it's going to get more problems in medical. We'll open it up again and get some more problems in medical, kind of that sine wave on the bottom. And we do think that as a management, you have to think about what's the state of suppression, what's the state of suppression by geography, what's the state over roughly a year after the first thing. So we're kind of beginning that year now, where you see the first curve coming down. And maybe we're all lucky and everything is very flat and there's no more COVID, or maybe we're going to go see, well, everybody's swimming in the Ozarks and now there's going to be a major outbreak in the Ozarks. And we don't know, but we do think this pattern is likely. And we do hope eventually we get to the point where the darn thing is cured. It's vaccinated, enough people have it that it goes back and we get to a more normal state. But again, 90 days ago, we would not have been having a conversation about a pandemic and credit models. So, polling question number one, and I want to be clear, we're talking about the Great Depression, not the Great Recession, not 2008, because in my opinion, I'm the bear. We think that COVID-19 is going to be worse than the 2008 cycle. So relative to the Great Depression, how do you think it will be in terms of credit issues compared to what happened, call it 90 years ago, call it 85 years ago? You'll get about a minute to answer, and appreciate your thoughts. Scott, if you're on the line, you can unmute. Do you have any opinions about where the crowd's going to come out?
I'm going to go with A, not as bad. Lock it in.
What an optimist.
Oh, interesting.
Interesting. So we have a split vote, I think. And I think, Scott, you tip the balance.
Great.
But not as bad as fantastic. Frankly, that's great news. That's almost market moving news. But thank you. Let me turn over to my partner, Scott, who will take us through the next conversation on responses to the commercial credit challenge.
Great. Thank you, Adam. So I'm going to focus most of my time today on the core credit risk issues, and then I'll touch briefly on execution and reputational issues as well. On the next slide, if we could move forward. I'll talk through each of these credit challenges in turn, and then talk about the elements of what we see as leading bank responses. So the first at the top, and I think the most important, is that COVID-19 has really left existing credit models and processes behind. We were talking to a CRO recently, and he said, you know, we've always underwritten on a through the cycle basis, and that doesn't work anymore. So so rating models and other credit models that rely on historical data really are not fit for this challenge when we've seen the bottom fall out of so many industries and where there's been such rapid dislocation. So how can banks address that? I think the first important thing is we see a need for very clear scenario definition at the bank-wide level. What's the duration of the impact? How big will the impact be, and for how long? So I'm sure at each of your banks, you're thinking about, you know, is this a V? Is this a W? Is this a U? Is this a very wide U, et cetera? We think that's critical, and banks need to have their best case outcome, and then they need to have some downside scenarios against that. And as Adam said, he tends to be a relative bear on this. I think we've seen in general, the macro forecasts have trended worse recently, and that most of our clients are viewing this as not necessarily a V, but more trending towards a U. Now, of course, having a high level macro view is not enough for lenders. So what credit teams need to do is they then need to disaggregate that macro view down into very detailed sector guidance, very detailed guidance in terms of revenues, in terms of margins, in terms of the cost base, personnel versus other costs, fixed versus variable, and effectively in terms of all the cash flow drivers so that individual lenders and credit officers can model out potential liquidity or credit support needed by clients, and therefore whether or not they think ultimately these clients are going to be viable when this whole thing is said and done. To give an example of that, one of our European clients has actually provided quite detailed sector guidance for 140 different sectors. And so that's the level of detail as we begin to understand the impacts, not just on the most heavily hit sectors, but all the interconnections between sectors. We think very detailed guidance needs to be going out. And then, of course, when we move past the sector, we know that every client is different. And so every bank will be out trying to get as much information as possible to take stock of current exposures, and also to make sure that when new requests come in, you've got an up-to-date view of those clients. In addition to relying on information that you get directly from your clients, we think it's absolutely critical to be looking at operating accounts, transaction banking activity, et cetera, and even leveraging the broader bank network, learning as much as you can, say, from the retail side, where they can see where card customers, et cetera, are spending on a global basis. So that's covering that first point. Moving to the second point, banker credit officer confusion, we had another CRO that we were speaking to basically say, look, everyone's at home right now. They're fielding requests from their clients. It's hard to get together. We talk a lot on Zoom. Everyone has Zoom eye by the end of the day, but we still don't feel like we really have a way of making sure that people are viewing credit decisioning consistently now, since it's been so crazy since the pandemic was declared and we started working from home. So one of the concepts we've been pushing, and I think this exists at many places, but not always in as structured a format, is the credit war room, or some of our clients like to call it the credit control tower. This is a centralized group focusing on prioritization and focusing on triage and trying to make sure the most important guidance gets out to people quickly. So to be clear, this is not individual client level or portfolio credit decisioning, but this is more saying, what's everything we need to get out into the network quick so that people can make the right decisions. That could be tactical changes to the credit process, new decisioning guidance, the sector guidance I talked about, guidance on new government programs as they roll out, et cetera. So all these things need to be centrally planned, and it's also important that people know not just what exists now, but what's coming. So that moves to the second point, proactive communication. We think it's really critical that that banks are focusing, clear, frequent communication, and also not just letting people know like what was the issue of today, but what's in the medium-term plan. And so I would encourage everyone listening, if there isn't a view over the next few months of new things that you expect to come out, continuing changes to how you do credit decisioning, et cetera, that making that clear to people is very important. And then finally, on the credit decisioning and allocation guidance, depending on where your institution is at, you may or may not have liquidity constraints or capital constraints. A lot of the biggest US banks, I think at this point, don't necessarily view themselves as being constrained on those dimensions. I think some other banks internationally are. To the degree that you have these various constraints, and you really are going to be constrained in terms of how you allocate the balance sheet, it's obviously important to have a view on strategic sectors, strategic clients, how you're going to allocate risk capacity, and to make that clear to folks as they're, no doubt getting a lot of different requests from their clients. Moving then to government lending programs, let me just first step back here and just talk about the overall Federal Reserve response. And I'm just going to focus on the US programs for today. So immediately when the pandemic was declared, the Fed came out and they basically reintroduced all their crisis era facilities, the commercial paper backup, money market mutual fund liquidity backup. They also announced the primary and secondary market credit facilities. And I think we've all seen this had a very calming effect immediately. And if you look at the commercial paper facility, the money market mutual fund facility, the take-up based on the latest reporting from the Fed hasn't been that large. So there was a calming effect, knowing that the Fed is sort of there with the bazooka ready to fire. But directly into the credit market in that capacity, they didn't actually have to fire too many rounds. The other, I think, relevant facilities that we've seen a little bit about in the press recently are the primary and secondary market credit facilities, where the Federal Reserve will look at anyone that was investment grade before the pandemic was declared and is currently at least BB minus, and they are willing to either take on syndicated loans or primary debt issuance, or to buy those in the secondary market. Now, important to notice that Adam showed credit spreads tightening significantly as these programs were originally announced, but these credit facilities are only just now rolling out. So it was only just recently the secondary market facility was rolled out. So you have this calming effect. Hopefully that will stay, stay in the markets. And I think Jerome Powell was quoted recently as saying something like, technically there's no real limit on what the Fed can do with its credit programs as this crisis continues to play out. Just commenting on a couple of the bilateral lending focused facilities that are on this page, the PPP and Main Street lending. In terms of PPP, this is really focused more on the smaller end, although it could apply to some fairly large companies, and we saw some of that in the press. It's really a grant disguised as a loan. As long as you use a majority of the money for personnel costs, you can get relief on that. We see the real challenge there now being towards the forgiveness applications and banks needing to have very specific processes and collect the right documentation for that. But that's, I think, mostly played out in terms of money going out the door there. The second one is Main Street lending. This was announced a while ago. It's not yet live. Now, this is a very interesting program, and we think it could be very valuable, but it's also been challenging for our clients, and so I'll talk about that. So first of all, the Main Street lending program applies basically to the entire middle market and right up into the corporate space. I think the revenue cutoff is around the Fortune 700 level. So some very large companies can get access to this. It's available to foreign banks, branches, IHCs as well, not just US institutions. And it's set up in such a way that if you're giving new loans or if you're giving an increase in exposure to existing clients, it's actually split 95-5. 95% goes to the Fed, 5% stays with the institution. So the design of this, we think, makes a lot of sense, where the Fed is really targeting borrowers that have been frozen out of the private markets, and thereby giving this facility where banks can lend and take on very little incremental risk. Most of it goes to the Fed. So the design of targeting a group of clients frozen out of the private markets, but who still, you think will survive the crisis, that's really where this is being targeted. The challenge that we see here is a lot of banks right now are scratching their heads, and they're basically saying, how is it that I run a borrower through my existing underwriting standards and get to a point where I say, well, I don't really want to lend to them on my own balance sheet, but I'll put it on the Fed's balance sheet. So they're having trouble squaring that circle. There's been a little bit of radio silence recently from the Fed, but we are still encouraging clients to say, look at the core intent, which is to find people that you think will survive, but where they're so uncertain and you're a little bit too nervous about putting the entire loan on your balance sheet, and target like a small sliver of these clients just past your risk appetite, but likely to survive, and aim aim them towards this program. So we'll see more playing out there, and definitely I think it's worth institutions that are looking at this for clients in that situation to continue to seek that. So hopefully everyone can hear me okay. The last is estimating credit losses. So when we saw the Q1 reporting from the big US banks, our main thought was twofold. First, that there's more coming in terms of increases in reserves. And the second was, how is everyone estimating this? So just very quickly on that, if you look at the pure credit impact, splitting out the CECL day one reserve increases, the reserves, even though they were much higher than previous reserves, obviously, were still relatively small in terms of comparisons to like DFAST or CCAR stress results. So we certainly think, both in terms of fundamental evaluation of the book and ratings, and in terms of macro scenarios, there's probably some worsening there, and we'll see a lot more coming through in the second quarter. And then in terms of how people are estimating this, going back to the original comments I made, it's so hard to re-rate the book, and macro conditioned loss forecasting models are not really built for what we're seeing. And so, we think certainly banks should be very willing to take a fundamental view of different sectors, to work bottom up, and then to consider overlays or adjustments to their CECL and IFRS 9 models. So moving to the next slide, and just very quickly, I'll go through these. In terms of execution and reputational risks, there's clearly the reputational risk where, in all these government programs, to some degree, some of our clients feel like they're sort of damned if they do and damned if they don't. There's a question of how you've allocated that program. There's a question of who gets it and who doesn't. And then there's obviously going to be a lot of hindsight risk. So in the PPP, not only who got the money, but also were they correctly given forgiveness, and can you monitor that? And with Main Street lending, when that goes live, we think there will be a lot of focus on, banks possibly that are towards the riskier end of ultimate loss levels, or clients who weren't able to get that. So we've been emphasizing that decision trails are very important, and I'm sure that's clear to everyone, but sort of in the fog of war, sometimes that gets lost. So again, having very clear decision trails and the monitoring and forgiveness trails for PPP. The third point, obviously, with stakeholder communication, things are very uncertain. It's important to be very direct and say what is known and what isn't known, and to therefore have a lot of qualifications around expected loss levels and reserving. The fourth, in terms of rolling out new programs, we think that every time there's a change to the credit process, new government program, et cetera, you need agile teams with business, risk, technology together and working very quickly towards 80-20 minimum viable products, not trying to make things perfect. The fifth, we already see some of our clients beginning to plan ahead and figure out which people they're likely going to take from the origination side through to the restructuring and workout side, and trying to forecast those volumes. And that's started to come, and obviously there'll be more later this year. So planning ahead for that is important. And then finally, when everyone's working from home, these things are harder to do. In particular, any sort of change to how you do things is difficult, and that comes back to the communication point. So if we go to the next slide, so just coming back to where I started, we talked about the fundamental credit challenge and the fact that historical data-based models don't really work very well. And so to deal with the COVID crisis, we've come around to a view that you need a very clear link from epidemiology to the specific, global, regional, state-by-state patterns for what that could mean in terms of degrees of social distancing, to overall views of macroeconomic impacts, and then to very specific sector level impacts that you can reflect into company level ratings and projections. In our experience, based on conversations in the market, banks do understand and agree with this view. Where they're really struggling is how to implement that in a practical way. And so we're going to have a polling question next, and then I'll hand off to Ross, who's going to talk about some work we've been doing and things we've been seeing in the market in terms of how to think about this challenge of the fundamental link from epidemiology all the way through to sector and client impact. So the question that we have for you is, how well prepared is your bank for handling commercial or corporate credit risk challenges over the next 12 to 24 months? So we thought people would be interested to see how their peers answered, and we're certainly interested to see what everyone's thinking on this dimension. And I'll take your cue, Adam, and I'll ask Ross to predict which outcome will win out here.
That's a good question. I think everyone would probably be lying if they said well prepared. So I suspect we're going to have a lot of folks feeling not well prepared, or probably okay but not confident, and maybe some feeling pretty well prepared.
See the results.
Oh, okay.
Good.
So folks are feeling more prepared than I thought they would.
Yep, and that aligns with my discussions with our clients. Is somewhere between pretty well prepared and maybe the occasionally slightly more honest, okay, we're not that confident. So with that, Ross, I'll hand off to you.
Thanks, Scott. So all the processes above are underpinned by credit loss estimates, and yet banks' traditional loss forecasting approaches, which are largely statistically driven at the core, have many problems in this current environment. So here we'll talk about some of those challenges, and then what we see leading clients doing about it. In terms of some of the issues with current approaches, firstly, all models rely on some historical sensitivity to the macroeconomy, which may or may not hold under the current environment, but likely won't, particularly if we have very extreme values of economic factors coming out, like the unemployment chart that Adam showed earlier. Additionally, there's no easy way to capture government support. We know that's significant, and Scott gave us a good rundown of all those things. And that support, it can be both directly to companies, e.g. through the PPP or sector-specific support, but also through to consumers, such that the macroeconomic impact is lessened, which complicates things. So we know it's out there. We know it's designed to reduce credit losses and economic damage, but it's difficult to quantify that. And then at the core, most corporate models rely on ratings heavily. So the rating models themselves tend to be based on historical financials, and hence they're relatively slow moving. And even Q1 financials, as those come through, don't have the full impact of economic lockdowns factored in. So ratings will be out of date or judgmentally adjusted for some time. And then also these rating models tend to be based on statistical models which combine factors that mattered in the past, and some of those clearly matter now, but some of them may matter less. So for example, if you've got 3-year average sales growth rate as a factor in the model, that may not be that relevant if your current revenue is down 90% because of lockdowns. And then finally, for the processes that take those corporate rating models and convert them into macroeconomically driven loss forecasting models for applications like stress testing and provisioning, they tend to have insufficient granularity in the corporate space, grouping together many industries that rely on very, or that are now under very different conditions due to lockdown. So often we see areas like oil and gas or specific industries like that separated, but for example, the models may not know how to treat differently a double B airline versus a double B tech company, which are clearly very different in today's environment. And finally, some of these models, depending on the model structure, rely on normal rating migration paths towards default, as opposed to companies going directly to default. And we expect that will also act quite differently right now as we have very sudden shocks to the economy. So we have expected high levels of credit losses and a lot of existing tools that don't work super well in this environment. So relatively big problem for banks. Can we go to the next slide, please, Adam? And so meanwhile, the economy is going to be totally determined by how well we can control the virus, as Adam alluded to, and also what we have to do to get there, in particular with lockdowns. So if we've got some scenarios here, and if we're smart and lucky, i.e. we have no more big waves of infection because immunity is working the way we expect and seasonality, etc., we might see something like a V-shaped recovery. But it's more likely, at least in our analysis, that there'll be some speed bumps along the road. Regional lockdowns are likely, as you can see in the range of plausible scenarios here. And it's also possible that we'll have repeated large-scale lockdowns leading to an economic crisis. So every time we open up the economy, the virus just gets out of control and we have to lock down again. While in emerging markets, it's also possible that countries just can't afford to do the lockdown or can't control the virus. And instead of having these repeated lockdowns, you just have a major health crisis where the virus really rips through the entire population. So none of these scenarios are particularly good. Next slide, please, Adam. So it's therefore imperative, we think, to start with the epidemiology and then go from there in terms of how you think about the economy and about credit risk. And that's part of the reason why we've built an epidemiological model called the Pandemic Navigator that I mentioned earlier, which we built originally for health and public policy use, but we're also finding it very useful for a range of private sector applications, like informing macroeconomic forecasts. And for those scenarios on the previous page, indeed, we've developed macroeconomic forecasts for each of those. But also decision support on the credit side, as well as operational processes like return to office, etc. And though it's not the focus of this presentation, I highly recommend that you visit the website, which there's a link to on the slides here, and look at some of the forecasts. They're at a very granular level, at county level in the US, and there are a lot of other interesting analyses to look at. But first and foremost, we think it's important to use this to perform credit analysis. So because of the problems I mentioned earlier with existing credit risk tools, we're seeing leading banks turn to detailed bottom-up client-level cash flow forecasting to get a better sense of what might happen to the portfolio and individual names under different scenarios. Some banks have put or have been and are putting tremendous effort into this kind of analysis to guide underwriting decisions, portfolio management, loss forecasting, etc. One major bank, as an example, told us they had hundreds of people, credit underwriters, trying to run a fairly detailed version of this across all of their corporate clients. And others that we've been working with are doing a more streamlined top-down version. So it all starts with the scenarios, epidemiological scenarios, importantly, and containment measures, and also sector assumptions for how well each sector will fare under the different scenarios. Of course, they all fare differently as we go from full lockdown to smart lockdown, etc. And then we also have at the bottom left starting financial data for each client, including their historical profitability, as well as any other information on how that client's business specifically has been affected. So, for example, from the client's transaction accounts, if you own the transaction information, or any other client-specific disclosures. And so based on those things, with a range of assumptions on revenue costs, mitigating actions by government, etc., you can develop a P&L and a cash flow projection for each client. And then finally, by setting sustainability criteria, for example, how much debt is too high, how quickly should a client have to pay down its debt before it gets to an unacceptable debt burden, banks can make an assessment of client viability, exactly as you would when doing underwriting for a new deal, or as is very commonplace in deals such as commercial real estate and project finance. You can do this for all clients and use that to inform estimates of default likelihood. As I mentioned, leading banks have been doing this and working on these approaches for a while now, starting with Asia and Europe, and now increasingly in the US as well. So next slide, please, Adam. So here's an illustration of how this works. So we have here the revenue for a given sector, an illustration of that. And this sector is particularly badly affected by the lockdown. So revenue falls significantly during the lockdown phase, and we already know some of these impacts from emerging data, for example, retail sales, credit and debit card transaction information, some company financials and disclosures. Then the situation will improve as we head into the smart lockdown phase, and we're just starting to see what that looks like a little bit in certain states in the US and some countries overseas. And then we'll gradually head towards a medium-term new normal, as we call it, which may still be worse than 2019. For the airline sector, for example, demand is expected to be depressed for several years potentially. But that new normal phase will be after the acute part of the virus. And so this is an illustration of what it might look like in, let's call it, the smart and lucky scenario, where we don't have repeated waves of lockdown. And you can do this analysis for not only revenue, but variable costs, payroll costs, other operational costs, etc. And based on that, build up the P&L profile of the forecast. Next slide, please, Adam. And based on this, and based on the viability criteria set, banks can forecast everything and also make a client level assessment on likely new debt requirements to get a client through a period of negative profitability, negative cash flows, and out to the other side, and also on the basis of that client viability. So in this example, you can see on the left we have revenue, cost, and P&L projections, then forecasts of free cash flows and new debt requirements in the middle, and then finally an assessment of the affordability of the new debt. So this client will require only a modest amount of debt in scenario 1 and can repay the loan relatively quickly. A more material amount of debt will be required under scenario 2, but the client can repay that loan over 5 years, so they will be more leveraged for the medium term at least. And then in scenario 3, the client becomes heavily leveraged and effectively a zombie or a non-viable company, unable to pay down the very high levels of debt. And clearly, these things have implications for credit ratings and loss forecasts. Let's go to the next slide. And then if we roll up from the client view to the industry view, banks can then develop a picture at the industry level. You can see here an analysis we've done for a sample of companies in select industries in the US, and the results are pretty intuitive and scary under the economic crisis scenario and even the middle scenario. And banks should be looking at this in a lot more detail, of course. So Scott mentioned we have some clients who are doing just this analysis with 140 or so different industries. And also the impact here will be different across country. So really, as a bank, you'd want to be doing this at the industry and geography level, and also looking across rating bands, leverage, and liquidity, which are all highly correlated with these viability outcomes. So with that, we have another poll question. Have you made or do you expect to make adjustments to your credit rating and loss forecasting models for COVID-19? We've already anchored folks to some degree on the previous ones, so I'm not sure. I'll just comment that really the analysis I've talked about here we see as complementary to existing approaches. So certainly banks aren't, and we're not expecting anyone to throw away their existing approaches. It's more recognizing some of the limitations of those and devising other analyses to address some of those limitations or complement the existing approaches. Okay, should we pull up the results, Stephanie, before we move to Q&A? Okay, that's kind of aligned with at least what I expected, with the mode being we have not yet, but expect to in the future make enhancements, or are unsure what to do. And some have already made adjustments, which is good to see. I'd be interested to know whether those are actual adjustments to models, or of course clients are already or banks are already going through and making adjustments to specific ratings for individual clients or coming up with model overlays. So maybe let's just summarize quickly and we can move on to Q&A. So in summary, we recommend 5 things. Firstly, setting up a war room to enable well-governed but agile first and second line decisioning. Secondly, enhance corporate credit risk analytics, and that has multiple components, as I've talked about, developing a range of scenarios tied to epidemiological outcomes and government policy response, performing bottom-up cash flow analysis across these scenarios to understand the impact on clients, and then combining these with with existing risk assessment processes to form a cohesive view. Thirdly, build a dynamic credit decisioning framework using this enhanced analytics. So update underwriting guidance and ensure the processes are appropriately governed via the war room setup, and make sure that this decisioning framework is practical under expected new waves of credit applications. Fourthly, understand the backbook portfolio impact. So feed the scenario analysis into not only allowance calculations, but also budgeting and capital planning processes and credit portfolio management decisions. And finally, look for new opportunities. So far, banks have mostly been defensive during the acute crisis part of this, and on keeping their current clients alive with provision of additional liquidity. But with better analytics and an improving outlook for some sectors at least, banks can start to look for pockets of opportunity once again. And will want to have the confidence through this type of analytics that they're making bets in the right places. So now it's time for Q&A. Francois, I'll hand over to you.
Yes, and so just a reminder, you can use the Q&A button at the bottom of the Zoom if you want to submit additional questions. So the first question I think will be for you, Ross. And the question is, how do you factor federal programs into your worst case scenarios? And in particular, what would be the regulators' expectation from that perspective?
Yeah, great question. And the answer is complicated, I suppose. So some government support can be relatively easy to factor in. So for example, we already know about the details of the PPP program, and under the assumption you make that that loan becomes a grant, it's relatively easy to see what that would be. Or Main Street lending with favorable interest rates, as an example, or any other known direct subsidy. And then other government programs are already flushing their way through the economy. So anything targeted to consumers is obviously already being seen in consumer spending patterns. The very challenging thing here is also that future support is likely in the negative scenarios in particular, but obviously difficult to take into account because we don't know the details of those scenarios or what the support will look like. I think this really depends on the purpose. So for stress testing purposes, you wouldn't want to assume significant government support that isn't already, committed, or at least you have a reasonable expectation of being there. And that's because of the nature of stress testing. You tend to take conservative assumptions. For general budgeting and forecasting, though, you want a more accurate answer, and therefore some expectation of government support can and should be built in. And in the absence of knowing anything specific, we think it's useful to consider different scenarios around what that future government support might look like. As for the regulators' expectations, definitely in stress testing, as I mentioned, there's a view towards being conservative, and the onus is on the bank to prove that something is going to be there. For others, regulators right now generally expect banks to be going through things in a thoughtful way and taking a balanced view. So I would expect that as long as the assumptions are well thought out and different scenarios are considered, there should be a reasonable solution.
Thank you, Ross. Next question, maybe Scott, you can have a go with it. Any thoughts on challenge or opportunities that kind of impact specifically FBOs? Is there like favorably or negatively, and how to deal with them?
So I think the core, I was just thinking about the government programs as well. I think the Main Street lending I talked about, and then the Fed's general market intervention are applicable to all banks. I think one of the challenges some FBOs may be feeling is obviously the funding profile, and maybe capital constraints are a little bit different, or how much flexibility they have in terms of dealing with clients in North America. Could be different than with the U.S. banks, but other than that, I'm not sure that there's any fundamental differences. I think everyone's struggling with this, and the types of analytics certainly that we talked about and the types of credit response are actually really informed, heavily by work that we saw kicking off in Europe, even ahead of the U.S. because of the onset of the virus there. So nothing else specifically comes to mind.
Thank you, Scott. And then maybe for Adam, do you see any disconnect between the equity and credit markets? And how do you see that evolving going forward?
Well, I think it's useful to note that the New York Stock Exchange opened up this morning. The Dow surged to 600 points. And I find it somewhat difficult to explain in light of actual economic activity. I don't think I'm alone in that regard. The equity markets are green. They had a fantastic April. I believe they'll have a fantastic, we're almost done with May. And the actual state of the American economy is nowhere near green. Credit markets are certainly functional, but it would be hard to find organizations that are stronger than they were. If you remember the list of names that were bankrupt and had all kinds of conversations in the press about future. So I think there is a very interesting disconnect. Equity markets are really based on, you know, forward expectations of earnings and dividends. So you can even rationalize the disconnect. Everyone expects a great last half of the year or 2021 plus plus. Credit markets are much more focused on cash and liquidity and sales. I think it'll be very interesting. Let's just pick the retail sector. In New York, we're beginning to open up the retail sector. In the short term, that is cash negative. People have to show up, staff has to show up, inventory has to be purchased, and customers may move, may come in, may not come in. That's very much of an unknown compared to prior art. Similarly in restaurants, tight margins, 25% spacing, very, very difficult to run at that capacity. So I continue to be an equity bear. I do think that cash flow per se will increase, whether it's sufficient to cover for the June 1 rent that a lot of organizations are going to have to go pay, or the series of fixed costs coming is, I think, you know, to be determined.
And then the final question for you, Scott. How are banks preparing for an increased wave of workout and restructuring?
What we've seen so far is banks reflecting either from their stress models or the more fundamental bottom-up view that they've developed, a view of essentially, you know, very rough timing and possible, you know, staffing requirements. That in our discussions, because responding to the immediate crisis has come first, and then most of this wave of, you know, insolvencies, whenever they come, will come later. We haven't focused as much on that preparation. So we've focused on, you know, are you building up your resourcing? Are you figuring out, you know, who you can move over from origination to workout? But we haven't gotten into the details of, say, workout strategies yet, et cetera.
Thank you, Scott. So we might have time for a final question for Ross. How do you expect some of the tools you described to be kind of temporary versus becoming a new standards for the industry after the peak of the crisis?
Oh, you're on mute. Oh gosh.
Ross, you're good.
Sorry about that. Good question, that one. So banks already use some of these tools for processes today. So in particular, at the time of underwriting, running some cash flow analysis, or as I mentioned, for specific sectors, this is a natural way of looking at the problem. For the broad corporate sector, I would expect that, you know, as we go back to normal times and some of the limitations of the statistical models that I talked about start to lessen, we will revert back to using those more in future. But obviously some of the learnings and the processes banks are developing now will prove to have real value, and banks will maintain some of that. One key difference has got to be that those need to be more industrialized and efficient than we've seen or heard from a lot of clients right now. So I mentioned having hundreds of people spending a couple of weeks looking through every client. That's clearly not something you can do on a regular basis. So I can imagine banks will have a more streamlined and an efficient view of this that they'll continue to use through the future in complement to their traditional approaches.
Thank you, Scott. I think we're up on time. Thanks a lot for participating in the webinar, and feel free to send us your questions after the session as well.
This is Bridget. I want to thank you all again, Ross, Francois, Scott, Adam, for this excellent presentation. We really appreciate it and look forward. I think this is going to be an ongoing discussion. So this is for sure one of the most challenging of the issues that members face. So we look forward to future discussions. And thanks everyone for joining. Everyone stay safe and stay well.
Thank you. Appreciate
you.
the opportunity.
Thank you, Bridget.
Thank you.